Hey, I see you. Don't sell your stocks yet. Has it been a year and a day yet? Has it been 366 days yet? No? Don't sell your stocks yet. Here's why. Hey guys, Lincoln here. Today I want to talk to you about short term versus long term capital gains tax and why you should always try to avoid short term capital gains. Because the tax man's going to come for you if you sell your stocks before a year and a day is up. And when that tax man comes, he's going to take all your money. So let's get into it. So short-term capital gains tax occur when you hold an asset for less than a year and a day. And when you do that, when you sell your asset before a year and a day is up, the government says, hey, we want you to invest longer, so we're going to penalize you for selling your asset too early. We want investors to hold their investments for a long time. So because you sold your shares before a year and a day, we're going to tax you at your ordinary income tax bracket. So based on how much you usually pay in taxes for your salary, for your normal income from a job, we're going to tax your profits from your stocks or real estate or whatever asset that you sold before a year and a day was up. So knowing that, let's look at what the alternative is. We don't want to sell our assets before a year and a day because that's going to be a very heavy tax burden. So let's look at long-term capital gains tax, and that's the alternative, right? The government wants us to hold our investments for a long time, like I said before. So they incentivize us by saying, hey, if you hold your stocks, your real estate, whatever asset that you purchased, if you hold it for at least a year and a day, we will give you a much lower tax rate. So as of 2020, if you earn profits of between zero and $40,000 in capital gains over a long term, so a year and a day, you pay $0 in taxes on those gains. So if you earn between 40,000 and a dollar to $441,000, the government will only charge you 15% taxes on those gains from your long-term holdings. And if you are savvy enough to earn more than or at least $441,000 in profits from your capital holdings over a year and a day, the government will say, hey, we're only going to charge you 20%. That's very cheap compared to the short-term ordinary tax bracket tax rates that the government charges you if you only hold your assets for less than a year and a day. So knowing all of this, we want to make sure that we hold our capital assets, our stocks, our real estate, our businesses, whatever is considered an asset that you will be taxed on. You want to hold that for at least a year and a day so that the government only charges you long-term capital gains tax. We want to avoid short-term capital gains tax as much as possible, but sometimes that's not possible. So just be aware that when you do have to sell an asset before a year and a day, that you will be charged ordinary tax rates for those gains. And there are ways around this. If you lose money, if you realize capital losses, then that can offset your capital gains. So that is one way to get around the short-term capital gains tax. But if you do realize capital gains in less than a year and a day, be aware that you will be taxed ordinary tax rates. So knowing all of that, when you go to purchase a new position or a new stock, invest in a new company, make sure that's a company that you believe in, that you understand, that you plan to hold for a long time, at least a year and a day, but ideally 2 years, 5 years, 10 years, 20 years, and let that appreciate, right? And once that appreciates, then go ahead and sell it if you need to. If you want to retire or you want to take a long vacation, then go ahead and liquidate that asset. But until then, until you need that money, plan to keep that investment, that asset for a long term. And as you hold that asset, know that you are saving yourself a lot of money in taxes by not selling quickly. So don't be a day trader, right? Day traders get taxed a lot because they're selling They're buying and selling every day, right? They're not holding for the long term. Of course, it's always good to realize profits, right? If you earn money, even if you get taxed, that's a good thing. But we want to maximize the money that we get in our bank account and minimize the amount of money that we have to pay to the tax man. Uncle Sam is not your friend. Do not give him free money. Be patient with your investment and hold on for a long term. Understand what you're investing in, believe in what you invest in, and that will make it a lot easier to hold that investment for over a year and a day. And if a year and a day comes up and you say, hey, Lincoln, I want to sell this position, I want to rebalance my portfolio, or I just want, I'm done, I want to retire, or I need this money for this big purchase, I want to buy the new Tesla. Go ahead. It's been a year and a day. You're gonna get taxed very low, and even if you realize $39,000, you won't be taxed at all because it's a year and a day. You earn less than $40,000. The government says, hey, you get a tax break. It's 0%. We won't tax you at all. So that will be great. So be patient, hold on, and only realize long-term capital gains. And it's as simple as that. So thank you for taking the time to watch this video and learn about long-term and short-term capital gains tax and the reasons why we want to avoid short-term capital gains tax at all costs. So if you like this video, like and subscribe, share it with anyone you think would find value in it, and I hope that you will stick around for the next video. Thank you. If you're just getting started in investing, there's no better place to start than Robinhood. I have a link to get a free stock from Robinhood when you sign up. You get a free stock, I get a free stock. It's a win-win. So if you're just getting started, join Robinhood, get your free stock, start investing, and hold for the long term. And I promise you, if you are patient, it will be worth it.